In this video, I'm going to show you why timing the market is a bad idea and how you can make more money by not doing it. In this video, I'm going to talk about something that a lot of people get wrong: timing the market. A lot of people think that they can time the market perfectly and make a killing in the process, but in reality, it's almost impossible to do. I'm going to show you why it's a bad idea and how you can make more money without having to worry about timing the market at all, and the scientifically proven best method of investing. What is efficient market hypothesis? The idea behind the efficient market hypothesis is that all potential inputs that could affect the price of stocks have already been considered. Eugene Fama, a financial economist, developed the idea of efficient market hypothesis as we know it today. In this fundamental study, Efficient Capital Markets, a review of theory and empirical work, Fama in 1970 conceptualized and established the idea. To put it another way, market efficiency in general is the belief that stock prices incorporate and represent all available information. However, all information is strictly dependent on market strengths. However, the core assumption of the efficient market hypothesis is that the stock prices absorb and reflect all relevant information. As a result of this, stocks are always reasonably valued. According to the efficient market hypothesis, it is difficult for investors to regularly earn alpha because stocks that are already reasonably valued outperform the stock market as a whole. Efficient market hypothesis and alpha. One of the most notable and continuous parts of the efficient market hypothesis is its assertion that it is impossible to reliably generate alpha. Indeed, this approach calls into question the validity and necessity of fund managers such as mutual fund managers, hedge fund managers, and whether they deserve high commission fees if they can't consistently obtain alpha returns. So if it's hard to continuously produce alpha, what's the point of paying fund managers exhibition fees? In case you're unfamiliar with the term alpha, it refers to the return that exceeds the excess market return. To put it another way, alpha is the technical phrase for beating the markets. Thus, if an investor obtains a higher return than, say, the FTSE 100 in the United Kingdom or the S&P 500 in the United States, he or she has earned alpha. So despite that alpha cannot be continuously earned, why are hedge funds still relevant? This is because consistently is the key word here. The efficient market hypothesis does not state that beating the market is impossible. Rather, it suggests and demonstrates that continuously outperforming the market is impossible. Many investors, including hedge funds, aim to routinely outperform the returns of benchmark stock market portfolios such as the S&P 500. This is where the issue arises. To regularly outperform the market, one must be able to identify stocks that are underpriced and primed to rise. According to the efficient market hypothesis, it is impossible for investors to regularly select stocks or other assets that provide higher returns than the entire market. The reason is straightforward. All information about a certain company that could affect the stock price is already available, either publicly or privately. This does, however, imply a completely efficient market, and there are some, but few, examples of people who have beat the market over extended periods of time. Importance of efficient market hypothesis. Wow, why bother investing if investors can't outperform performance measures? According to the efficient market hypothesis, the only way for investors to generate money consistently over time is to invest in the entire market. In other words, the efficient market hypothesis suggests that investing in low-cost, extensively diversified, passively managed index funds is likely the best option. Now let's come to another important part of this video, that is dollar cost averaging. What is dollar cost averaging? Dollar cost averaging is a technique that involves investing equal sums of money at regular intervals, regardless of the asset's price or what is happening in the financial markets. These regular investments can be in the form of a defined sum of money or a fixed number of shares. The intervals can be weekly, monthly, yearly, or whatever an individual's investing strategy dictates. When prices are high, you can only afford a fixed amount of shares according to this technique. When prices fall, you can buy additional shares with the set amount you invest each time. When the market recovers, you will gain from having more shares because you purchased them at a low price. What is the process of dollar cost averaging? We'll go over a hypothetical case to better understand how dollar cost averaging works. Assume you put $100 a month into an index fund for 5 months. Because share values fluctuate at each period, you receive a different number of shares each time you invest $100. After 5 months of making equal monthly contributions, your total investment is $500. If the first purchase was at the top of the market, you'd get a better cost per share in the following months. That way reducing the risk of putting in a lump sum and getting surprised by the market. Of course, this is not to claim that employing this method will always result in profit, nor will it insulate investors from decreasing share prices. Dollar cost averaging versus timing the market. Timing the market is an investment strategy in which investors try to outperform the stock market by forecasting its performance. It is an active strategy that focuses on the near term and necessitates close attention and market monitoring. Dollar cost averaging, on the other hand, is a strategy for passive investment. Because you invest the same amount of money regularly, this technique does not necessitate as much market attention. You also construct a position in a stock, bond, or fund rather than entering and quitting separate holdings. By trying to time the market, you're also neglecting the efficient market hypothesis, which states that all information is already reflected in the market price. Therefore, index fund investing combined with dollar cost averaging might be the hypothetically most optimal investment strategy in the metrics of consistent returns and lower risks. Advantages of dollar cost averaging. One advantage of dollar cost averaging is that it removes emotional considerations from investing. Because you invest on a regular basis, regardless of market conditions, emotions are removed from the decision-making process. For example, if the market is falling, some investors may panic and liquidate their assets. With this method, it can be viewed as a chance to acquire at a low price, while keeping in mind that this strategy is normally employed for long-term investment goals. This investment method can also help to average out share price swings and minimize the amount you pay each share. Because you acquire more shares when the prices are low, the average cost per share you spend is usually lower than the average share price. Furthermore, this method allows investors who do not have a huge lump sum of money to gradually establish a position in the market. Some investors, for example, may have $10,000 to invest all at once. Others, on the other hand, may not have such money at one time, but can apply the method for DCS to build up to a position worth $10,000. That was our video on the efficient market hypothesis and the dollar cost averaging investment method. I hope you learned something today, and if you're interested in finance basics and news, we recommend you subscribe to our channel.